Hello everyone and welcome to my channel, Compliance Lookup. In this video, we will be discuss anti-money laundering and combating the financial terrorism and its legislation in India. If you have not watched chapter 5 then, please watch first. These topics are essential for financial security and in future videos we will dive deeper into how these procedures are implemented, the tools used, and the real world impact they have on businesses and individuals. If you found this video helpful, don't forget to like, share, and subscribe for more content on financial compliance, regulations, and more. Now let's start this chapter. The AML-CFT legal framework, which is based on the Prevention of Money Laundering Act (PMLA) 2002, enacted as the primary law against money laundering, in line with international guidelines. The Unlawful Activities Prevention Act (UAPA) 1967 was also amended to address terrorist financing. The Financial Intelligence Unit India FIUIND oversees reporting of suspicious transactions and issues guidelines to financial institutions. Sector-specific regulators like RBI, SEBI, and IRDI provide industry-focused guidelines to help entities meet their AM and CFT obligations. The Indian Banks Association IBA has developed operational guidelines for banks to ensure compliance. Now coming to overview of legal framework in India for AML-CFT. A comprehensive evaluation of the country's legislative and administrative arena for prevent of money laundering and countering the financing of terrorism was made by FATF in November-December 2009. PMLA was amended in 2005 and thereafter in 2009 and 2013 to overcome difficulties being faced in its enforcement and to conform to the international standards. Thereafter, it has been amended several times to enhance the ML measures. Now coming to the Prevention of Money Laundering Act (PMLA) 2002. This is a comprehensive legal framework in India designed to counteract money laundering and its associated criminal activities. The law is significant in its role of establishing legal, financial, and enforcement mechanisms to detect, prevent, and punish those involved in money laundering. The Act has undergone several amendments over the years to address emerging challenges and ensure its effectiveness in the face of evolving financial crimes. A. Important amendments to PMLA. 1. Amendment of 2005. This amendment was crucial in expanding the reach of PMLA by including more offences as predicate offences. A predicate offence is a criminal offence that generates proceeds of crime, which then become the subject of laundering. By widening the range of such offences, PMLA could now target a broader spectrum of criminal activities. This allowed authorities to pursue not only traditional crimes like drug trafficking but also economic crimes such as tax evasion or fraud. I will take an example. A company evading taxes would now be investigated under PMLA because tax evasion is a predicate offense. If the proceeds of the evasion are used to buy property, those assets can be seized under the PMLA. 2. Amendment of 2012. This introduced the provision for the establishment of a special court under PMLA. The purpose of the special court is to expedite the trial process, ensuring that cases of money laundering are resolved more swiftly, which is critical in deterring financial crimes. Before this amendment, cases often got delayed in regular courts due to the backlog of cases. Example: a major corporate fraud case involving proceeds of crime amounting to Rs 50 crore can now be fast-tracked through a special court to ensure a timely conviction. 3. Amendment of 2018. This was a landmark change as it significantly enhanced the powers of the Enforcement Directorate, which is responsible for investigating and enforcing PMLA. It granted the aid the ability to attach property suspected to be proceeds of crime even before conviction. This preventive measure ensures that assets acquired through illegal means are not disposed of while the case is pending. Example: if an individual is under investigation for laundering money through real estate purchases, the aid can attach the properties before the individual is convicted, preventing any sale or transfer during the trial. B. Reporting entity. The reporting entity RE refers to any person or entity required to report suspicious transactions under PMLA to the Financial Intelligence Unit India FUIN. These entities are critical in identifying and reporting potential money laundering activities. Reporting entities include: first, banks, they must report large or suspicious transactions. Second, financial institutions. These include insurance companies and stock exchanges. Third, intermediaries, such as stockbrokers and insurance agents. Fourth, dealers in precious metals and stones, those involved in high value transactions that could be used to launder money. Fifth, casinos, which are often targeted for laundering due to the large cash flows involved. Example: a jeweler who sells diamonds worth Rs 50 lakh in cash would be required to report this transaction to FIO and to ensure it isn't part of a money laundering scheme. C. Obligation of reporting entities. Banks, as reporting entities, have specific obligations under PMLA to help prevent and detect money laundering activities. 1. Customer due diligence (CDD). Banks are required to verify the identity of their customers and ensure they are not engaging in illegal activities. This includes collecting details such as Aadhaar, PAN, and conducting background checks. Example: when opening a bank account, the bank verifies the customer's identity and source of funds to ensure they are not proceeds of crime. 2. Suspicious transaction reporting (STR). Banks must report any suspicious transactions to FIOINT. A transaction might be flagged as suspicious if it involves unusually large cash deposits or seems inconsistent with the customer's profile. Example: if a customer with a modest salary suddenly deposits Rs 1 crore, the bank must investigate and report it as a suspicious transaction. 3. Maintaining records. Banks are required to maintain records of transactions and customer details for a minimum of 5 years. This helps in investigations and audits to reconstruct events if any laundering is suspected. Example: a bank keeps detailed records of transactions from a business account, which can be used in future investigations if the account is suspected of laundering money. D. Corrective punitive actions of non compliance. Failure to comply with PMLA's requirements can result in serious consequences for reporting entities, including: 1. Penalties. Monetary fines are imposed on banks or financial institutions that fail to report suspicious transactions or conduct due diligence. The fine ranges from Rs 10,000 to Rs 100,000 for each failure. Example: a bank that fails to report multiple suspicious cash transactions could face a hefty fine for each transaction it neglects to report. 2. Legal action. The authorities can initiate legal proceedings against the reporting entity and its officers for serious violations. The entity can also be blacklisted. Example: a bank involved in a major money laundering case may face legal action, including criminal prosecution of its directors and senior officers. 3. Reputational damage. Non compliance can cause severe reputational damage, leading to a loss of customer trust and potential legal consequences. Example: a bank fined for non compliance could lose customers due to the negative publicity. E. Offense of money laundering. PMLA defines money laundering as any process involving the proceeds of crime, including concealment or possession of crime proceeds, acquisition or use of property knowing it comes from criminal activity, inducing others to participate in laundering. Example: if someone knowingly buys a car using money earned through smuggling, they are guilty of money laundering. F. Punishment for the offense of money laundering. The punishment for money laundering under PMLA includes rigorous imprisonment of 3 to 10 years, fines based on the severity of the crime. In some cases, both imprisonment and fines are applied. Example: an individual caught laundering 10 crore may face a 7-year prison sentence and a fine based on the value of the proceeds of crime. G. Predicate offense for the offense of money laundering. A predicate offense refers to any crime that generates proceeds which are then laundered. Common predicate offenses under PMLA include terrorism, funds used to finance terrorist activities, narcotics trafficking, money generated from drug sales, human trafficking, proceeds from the illegal trade of humans, corruption, funds generated through bribery or embezzlement. Example: an individual involved in drug trafficking who launders the proceeds through real estate is guilty of money laundering, with drug trafficking being the predicate offense. H. Other provisions of PMLA. 1. Confiscation of property. The authorities can confiscate properties acquired through proceeds of crime. Example: if a criminal uses laundered money to buy a house, the house can be seized by authorities. 2. Search and seizure. Authorities are empowered to conduct searches and seizures to gather evidence related to money laundering activities. Example: law enforcement officers can raid a suspect's home and seize documents or cash related to illegal transactions. 3. Attachment of property. The authorities can attach property suspected to be involved in money laundering even before a conviction. Example: if a business is suspected of laundering money through large cash transactions, the government can freeze its assets pending investigation. Now, coming to conclusion. The PMLA is a vital law in India's fight against money laundering, ensuring that the financial system is not used to fund criminal activities. Its amendments have strengthened enforcement, broadened its applicability, and made compliance essential for all reporting entities. By adhering to PMLA, banks and financial institutions help maintain the integrity of the financial system while minimizing the risk of being exploited for illicit purposes. Now, coming to the Prevention of Money Laundering Maintenance of Records Rules 2005.PMLRR are an essential part of India's fight against money laundering and financial crimes. These rules work under the umbrella of the Prevention of Money Laundering Act 2002. PMLA, providing specific instructions for financial institutions and other businesses known as reporting entities on how to maintain customer records, monitor transactions, and report suspicious activities to the authorities. Let's break this down step by step so you can understand the role and importance of these rules in India. 1. Purpose of the rules. The PMLR serves three main purposes. A. Prevent money laundering. The rules are designed to help reporting entities like banks, financial institutions, and stockbrokers comply with the PMLA's guidelines. By doing so, they prevent criminals from using the financial system to clean or launder money derived from illegal activities. Example: imagine a businessman who earns illegal money from smuggling goods. He tries to deposit this money into a bank account. The PMLR requires the bank to verify his identity, monitor the transactions, and report any suspicious behavior to the Financial Intelligence Unit file. This helps authorities track the flow of illegal funds and prevent further laundering. B. Assist investigations. The records maintained by reporting entities under these rules become crucial evidence when law enforcement agencies, like the Enforcement Directorate (ED) or the police, investigate money laundering cases. Example: let's say a jewelry dealer is involved in laundering money by selling precious gems bought with illegal funds. The dealer's records of customer transactions and payment methods could help investigators trace the source of the money, providing vital leads in the case. C. Enhance transparency. The rules promote transparency in financial dealings by requiring businesses to keep records of their transactions and customer details. This makes it harder for people to hide or transfer illicit money without getting noticed. Example: a company making large wire transfers overseas must report these transactions, reducing the chance of money being transferred for illegal purposes like drug trafficking or tax evasion. 2. Amendments to the rules. Over the years, the PMLRR has been amended several times to make sure it stays up to date with changing circumstances and threats. These amendments aim to: A. Incorporate evolving international standards. India wants to align its rules with international anti-money laundering and counter-terrorism financing standards. Organizations like the Financial Action Task Force provide recommendations that countries should follow to combat financial crimes globally. Example: after FATF recommended stronger controls on the financial dealings of politically exposed persons, PEPS India updated its rules to ensure banks and financial institutions follow stricter verification and monitoring processes for such individuals. B. Strengthen the regulatory framework. The rules were modified to make compliance more effective. This includes stricter guidelines for customer verification, transaction monitoring, and reporting to authorities. These stricter guidelines ensure that reporting entities stay proactive in preventing money laundering. Example: after amendments, if a bank notices unusual activity in an account, example, sudden large deposits inconsistent with the customer's profile, it must investigate further and possibly report the transaction, ensuring that criminal activities are flagged quickly. C. Address emerging risks. Money laundering techniques are constantly evolving, with new risks emerging as criminals find more sophisticated ways to conceal their activities. The rules are regularly updated to cover new areas of concern, such as the use of cryptocurrencies or cross border money transfers. Example: in recent years, amendments have included digital KYC procedures to address the risks associated with online financial transactions, where verifying a customer's identity becomes more challenging. 3. Important amendments. Several key amendments have enhanced the effectiveness of the PMLR. A. Inclusion of new categories of reporting entities. Initially, the rules covered mainly banks and financial institutions. Over time, amendments brought in other sectors like dealers in precious metals and stones, casinos, and real estate agents. These businesses often handle large amounts of cash and can be used to launder money. Example: a real estate agent who helps a client buy property with cash needs to report this transaction, especially if it involves unusually large sums, as it could be an attempt to launder illegal money. B. Enhanced Customer Due Diligence (CDD). The rules have been updated to require more stringent customer verification, particularly for high risk clients. Enhanced due diligence is required for customers involved in high value transactions or those operating in high risk regions. Example: A person from a country known for high levels of corruption or terrorism financing would undergo extra scrutiny when opening a bank account in India. The bank would need to verify not only their identity but also the source of their funds. C. Technological advancements. The amendments also introduce provisions for using digital records and electronic KYC know your customer systems. This allows banks and businesses to collect customer data more efficiently and store it securely in digital formats. Example: with digital KYC, a person can now open a bank account online by submitting their identification documents and photograph through a secure app without needing to visit a branch. This makes it easier to comply with KYC requirements in a tech-driven world. 4. Salient provisions of the rules. The core provisions of the PMLR lay out the specific obligations for reporting entities. A. Record keeping requirements. Reporting entities are required to maintain detailed records of all financial transactions, including cash deposits, wire transfers, and even smaller transactions that seem suspicious. These records help track money laundering activities and are essential for investigating crimes. Example: a jeweler selling a gold necklace for Rs 20 lakh must keep a record of the buyer's identity and the payment method cash or wire transfer. If the buyer turns out to be involved in illegal activities, these records will help investigators. B. Customer Identification KYC. Every reporting entity must verify the identity of its customers by collecting valid documents like RRR, PAN card, or passport. This helps ensure that customers are legitimate and reduces the risk of criminals using fake identities. Example: a bank will not allow you to open an account without submitting your Aadhaar or PAN card and other proof of address. This ensures that your identity is verified, and if your account is later found involved in illegal transactions, the authorities can trace it back to you. C. Suspicious Transaction Reporting (STR). Reporting entities must monitor transactions for any suspicious activities, such as large cash deposits, frequent foreign transfers, or unusual business deals. If a transaction looks suspicious, the entity must report it to the Financial Intelligence Unit India. Example: a person who deposits rupees 50 lakh in cash without a clear business purpose will likely have their transaction flagged as suspicious and reported to FIRE for further investigation. D. Record retention. Reporting entities are required to retain these records for at least 10 years, even after a customer closes their account or a transaction is completed. This helps in long-term investigations of money laundering cases. Example: a bank will store details of a customer's last transaction for 10 years so that if the customer becomes involved in an investigation several years later, the records will still be available. E. Confidentiality. The rules also emphasize the importance of maintaining customer confidentiality. Reporting entities cannot disclose customer information to unauthorized parties unless required by law. Example: if a bank suspects a customer of money laundering, it must keep the investigation confidential and report it only to the FIO, not to other customers or third parties. Conclusion: the Prevention of Money Laundering Maintenance of Records Rules 2005 (PMLRR) are a crucial part of India's efforts to prevent money laundering and terrorist financing. They ensure that reporting entities, like banks and businesses, maintain proper records, verify their customers, and report suspicious transactions to the authorities. By following these rules, reporting entities help in creating a transparent and secure financial environment that deters criminals from using the financial system for illegal purposes. The amendments over the years have kept these rules up to date with international standards and technological advancements, ensuring India's anti-money laundering regime remains robust and effective in tackling new and emerging threats. Now coming to next, the Unlawful Activities Prevention Act UPA 1967. This is a critical law in India designed to combat activities that threaten the sovereignty, unity, and integrity of the country. The Act has been amended several times to keep pace with the evolving nature of terrorism and unlawful activities. Let's break it down in a simple to understand the law and its impact on individuals and national security. 1. Overview of YOPA. Objective. The main objective of YOPA is to prevent unlawful activities and acts of terrorism that pose a danger to India's sovereignty and integrity. It also targets individuals or groups that promote secessionism or engage in acts that could destabilize the country. Key features. 1. Designation of organizations as terrorist organizations. The government can declare any organization a terrorist organization if it is involved in activities that are dangerous to the country's security or public safety. An example. The government of India has designated several organizations such as Lashkar as terrorist organizations because they engage in attacks on Indian soil. 2. Powers of investigation and prosecution. UOPA gives wide powers to law enforcement agencies like the police and the National Investigation Agency NIA to investigate and prosecute offences related to terrorism and unlawful activities. Example. After a terrorist attack, agencies like the NIA can use UOPA provisions to arrest suspects, gather evidence, and prosecute those involved in terrorism. 3. Attachment of properties. Under UOPA, the government can attach properties believed to be acquired through unlawful or terrorist activities. Example. If a terrorist organization owns a building or property that was purchased using funds from illegal activities, the government can seize or attach that property to stop its use. 4. Preventive detention. UAPA allows for preventive detention, meaning individuals suspected of being involved in terrorism or unlawful activities can be detained before committing any crime. Example. If the police believe someone is planning a terrorist attack, they can detain that person under UAPA without waiting for the crime to happen. The Unlawful Activities Prevention Act UAPA 1967 is India's primary anti-terrorism law. It plays a critical role in maintaining the country's security and sovereignty by defining what constitutes a terrorist act and by criminalizing the financing of terrorism. Understanding Section 15 definition of a terrorist act. Section 15 of the UAPA defines a terrorist act in broad terms. Let's break this down with examples to understand each element of the definition. 1. Threatening or likely to threaten the unity and integrity of India. This refers to any action aimed at breaking the country apart or challenging its unity. Example. A separatist group engaging in armed attacks to demand the division of a state from India could be considered a terrorist act. Their goal is to threaten the unity of the country by promoting a separate entity. 2. Striking terror in the people or any section of the people of India. Acts intended to create fear or terror among the general population or a specific community fall under this definition. Example. The 2008 Mumbai attacks, where terrorists targeted crowded public places, killing civilians and creating widespread fear, are a clear example of a terrorist act aimed at striking terror in the people. 3. Affecting the sovereignty and security of India. Acts that threaten India's control over its territory or its overall security. Example. If a terrorist group smuggles weapons into the country to weaken the government's control or attacks military installations, it would directly affect the sovereignty and security of India. 4. Creating public disorder. Acts that cause chaos and disruption to public life, such as rioting or mass violence. Example: a bomb blast in a crowded market designed to create panic and disorder among the public would be considered a terrorist act under this provision. 5. Causing widespread damage to property and infrastructure. Acts that destroy buildings, roads, bridges, or other infrastructure. Example: a group plants explosives to blow up a railway station, causing major damage to public infrastructure and disrupting transport services. This would clearly fall under a terrorist act as it damages vital infrastructure. 6. Disrupting essential services. Acts that interrupt services such as electricity, water supply, or communication networks. Example: a cyber attack that shuts down a city's power grid, leaving thousands without electricity, is a terrorist act because it disrupts an essential service. 7. Creating reasonable apprehension or fear of any of the above results. Acts that create a serious fear that any of the outcomes mentioned above could happen, even if they do not. Example: a group sends a threatening message about bombing a major city. Even if no attack occurs, this act creates fear and apprehension among the people and can be considered a terrorist act under Section 15. Section 16. Offense of raising funds for terrorist organizations. While terrorist acts require significant resources, Section 16 of UPA specifically targets the financing of terrorism. The law recognizes that terrorist organizations rely on funds to plan and execute attacks, so it criminalizes the act of providing or collecting funds for such groups. Key points of Section 16. 1. Prohibition on raising funds. Any person who knowingly provides or collects funds for a terrorist organization or for an activity likely to be used for terrorism is committing an offense. Example: a businessman donates a large sum of money to a charity that is secretly funneling funds to a terrorist group. Even if the businessman doesn't directly participate in terrorism, he is guilty of financing terrorism under Section 16. 2. Punishment for raising funds. The punishment for this offense includes imprisonment for up to 7 years and a fine. Example: a person caught transferring funds to an overseas terrorist organization may be sentenced to jail for up to 7 years and fined, even if they weren't involved in any violent act themselves. Why these sections are crucial for combating terrorism. Criminalizing terrorist acts. Section 15's definition of a terrorist act is broad and designed to cover a wide range of activities that threaten the national security of India. By including acts that create public fear, damage infrastructure, or threaten essential services, the law ensures that even preparatory actions that could lead to terrorism are punished. Targeting terrorist financing. Section 16 goes after the finances that fuel terrorism. Without funding, terrorist groups cannot operate, and their ability to plan and execute attacks is limited. Criminalizing the raising of funds for terrorist groups is a critical step in cutting off the resources that enable terrorist acts. Real life example: terrorist financing in India. One of the notable cases involving the financing of terrorism was the crackdown on Hawala operators who were channeling money to terrorist groups operating in Kashmir. In these operations, large amounts of unaccounted money were being transferred between individuals and organizations under the guise of normal business transactions, with the real purpose being to fund terrorism in India. In such cases, the UEPA allows the authorities to not only arrest the individuals involved but also to seize the funds and freeze any bank accounts associated with the funding of terrorist activities. This helps disrupt the financial networks that terrorist organizations depend on. Coming to conclusion, Sections 15 and 16 of the UEPA are vital tools in India's fight against terrorism. By broadly defining terrorist acts and criminalizing the financing of terrorism, these sections ensure that the government can act swiftly to prevent attacks and disrupt the support systems that enable terrorism. The law provides a framework for authorities to not only punish those directly involved in terrorist activities, but also those who support and fund such actions from behind the scenes. 3. Offense of raising funds for a terrorist organization. The offense of raising funds for a terrorist organization is a critical part of countering terrorism financing. It is dealt with in India's Unlawful Activities Prevention Act, UEPA, specifically in sections 17 and 40. Let's break it down with explanations and examples. Section 17 of UEPA. This section focuses on the punishment for raising funds for terrorist acts. It criminalizes the act of raising funds for the specific purpose of carrying out a terrorist attack or for an organization engaged in terrorism. Example: if a person is found collecting money to finance an attack on a government building or to support a terrorist organization like Lashkar-e-Taiba, they would be committing an offense under Section 17. The punishment is severe and includes life imprisonment and a fine. Section 40 of UPA. Section 40 addresses the offense of raising funds for a terrorist organization. It makes it illegal to raise funds for any group or organization that is declared to be involved in terrorism, even if the funds are not directly meant for a specific terrorist act. Example: suppose an individual is raising funds for an organization like the Indian Mujahideen, which is recognized as a terrorist organization. Even if the funds aren't immediately tied to a specific attack, the person is still committing an offense under Section 40. Key points: 1. Criminalizes fundraising. Both sections criminalize raising funds for terrorism, whether for an immediate terrorist act or for the support of an organization involved in terrorism. 2. Severe punishments. The punishment for these offenses is life imprisonment and a fine, highlighting the seriousness of the offense. 3. Crucial for national security. These provisions help prevent the flow of money to terrorist organizations, which is essential for national security. Example of a case: imagine a person who is actively involved in collecting donations for a terrorist organization, such as the Taliban, to support their operations. The individual uses online platforms and social media to gather funds from sympathetic individuals or groups. Under the UEPA, the individual could be charged under Sections 17 and 40 because they are providing financial support for terrorism, leading to severe punishment. Connection to other laws. Alongside UEPA, India also uses the Prevention of Money Laundering Act (PMLA) to combat the laundering of terrorist funds. The PMLA criminalizes the process of hiding the origins of funds used for terrorism, strengthening the legal framework. Conclusion: Sections 17 and 40 of UEPA are powerful tools in preventing terrorism financing by penalizing those who raise funds for terrorist activities. This framework is crucial for maintaining national security and combating terrorism at its financial root. 4. Power to attach freeze funds or financial assets of specified individuals and entities. Let's break this down step by step to understand how different laws in India allow authorities to attach or freeze funds and financial assets of individuals or entities involved in terrorism, money laundering, or other illegal activities. This power is crucial because it helps prevent criminals or terrorists from using their financial resources to carry out further illegal acts. I'll explain each law and give examples for better understanding. 1. Unlawful Activities Prevention Act 1967 UAPA. The UAPA is a law focused on preventing terrorism in India. Section 25 of this act allows the government to freeze or attach funds linked to individuals or groups suspected of supporting terrorism. Section 25 power to freeze or attach funds. What it does. This section empowers the government to freeze or attach the financial assets of individuals or entities suspected of engaging in terrorism or having links with terrorist organizations. Example. Let's say authorities suspect an individual is funneling money to a group like Lashkar-e-Taiba. Under Section 25, the government can immediately freeze the person's bank accounts or seize any property tied to them. This action is taken even before the person is convicted in court to prevent the terrorist organization from benefiting from these funds. 2. Disaster Management Act 2005. The Disaster Management Act DMA is not just for dealing with natural disasters, it also provides powers to the government to deal with the financial resources of entities involved in criminal activities, especially terrorism. Section 51, a freezing or seizing assets. What it does. This section gives the central government the power to freeze, seize, or attach financial resources like money or property linked to individuals or groups listed under the schedule of the Act, including terrorist organizations. Prohibit financial dealings with these listed entities. Block transfers of funds to or from these entities. Example. Suppose the Indian government identifies a terrorist group, such as Al Qaeda, listed under this Act. The government can immediately freeze the group's bank accounts, stop any financial transactions involving them, and seize any assets associated with the group. This makes it difficult for the group to continue financing its operations. 3. Prevention of Money Laundering Act 2002 PMLA. The PMLA focuses on preventing the laundering of money, which includes the act of hiding or legitimizing funds earned through criminal activities like terrorism or organized crime. Powers under PMLA. The Enforcement Directorate has the authority under PMLA to attach properties or freeze assets that are acquired through criminal activities even before the person is convicted. This helps stop criminals from enjoying the profits of their crimes and disrupts the financial networks they rely on. Example. If someone is found to be involved in laundering money for terrorist activities, the aid can seize their property, such as real estate or luxury cars, and freeze their bank accounts. Even though the individual hasn't been convicted yet, the authorities can take these actions to stop the terrorist group from benefiting financially. Key points. 1. Disrupting financial networks. These laws are designed to cut off the financial resources of criminals and terrorist organizations. By freezing or seizing assets, authorities prevent further illegal activities from being funded. 2. Preventing the use of illicit funds. By acting quickly to freeze assets, authorities ensure that criminal organizations can't use illegally obtained money to fund their operations, which could otherwise lead to further harm or violence. 3. Due process and safeguards. While these powers are important, they are exercised carefully and in accordance with the law. Due process ensures that individuals' rights are respected and the use of these powers is justifiable and lawful. 4. Collaboration with other measures. These powers are often used alongside other investigative tools, such as surveillance or intelligence gathering, to tackle crimes like terrorism and money laundering more effectively. Conclusion. In summary, India has strong legal provisions that allow the freezing or attachment of funds linked to terrorism, money laundering, and other criminal activities. Laws like the UEPA, the Disaster Management Act, and the PMLA give authorities the necessary tools to disrupt criminal operations by cutting off their access to funds. This helps prevent further crimes and ensures that criminals and terrorists cannot profit from their illegal activities. So we have completed this part one of this chapter of anti-money laundering and combating financial terrorism legislation in India. If you want to get update of this topic, then please press bell icon of this channel. Thank you so much for watching this video.